Hello. Excellent. There we are. Thank you very much for joining me today for the look ahead to the coming week, which is the week kicking off the 2nd of December. Yes, that's right. You heard it. We are entering December. Where has that gone? So just as always, we'll start by just asking you to read through the risk warning. Just going to pop myself on mute for a moment whilst you read through that. Thank you. Excellent. So let's just get started straight away then. I think what we're going to do quickly is have a look at what's been going on, some big movers that we had this week before we just jump on to the economic calendar for the week ahead. I think the most standout mover that we saw was US dollar, Japanese yen. This is really interesting. Obviously, we've had a weaker US dollar this week. It's the first softer US dollar. It's the first week that the US dollar has actually fallen after 8 weeks of gains. So that's fairly significant. But at the same time, we've also seen a strengthening in the yen on expectations that the Bank of Japan will be cutting rates. Now, I've just brought this one up because there isn't actually particularly much data relating to the Japanese yen next week, but I just think that this is a really interesting chart because we've seen that roll over really. We've hit that peak there at the 156.75, seen it take out this trend line, which dates all the way back to 2022. We've taken out the 200 SMA. We're below the 50 SMA. We're taking out these fib levels. So, you know, there's quite a lot going on here. I think the next one to be watching out for there is the 100 SMA, which is around the 149. So I'm just trying to see on my chart. It's not showing up very clearly. Here we go. The 149. 30 level, that's going to be the next one to watch on the downside. Then we've got these fib levels here at the 158 and the 146.50. That was the low we saw in March. So I think the thing that we know about the Japanese yen and the US dollar Japanese yen is it does tend to trend. So this is a pair which often when it picks up a trend, it tends to go for it. So we've seen that on the way up, we've seen it on the way down, we've seen it on the way up. Now we're just going to have a look to see whether it's going to be able to make it on the way down. I think I'll be watching out for that. Yeah, that one level, that 100 SMA there around the 149.30, 149.20 level. Also the high there that we saw in mid-August. So just levels to be watching out there for the USD Japanese yen. Interesting week though overall. As I said, we saw that not only did the US dollar fall lower this week, we also saw some all-time highs on US equities as well. There wasn't so much as far as data is concerned outside of, no, there was actually, we did have data, but we saw Trump sort of driving trade at the beginning of the week with those trade tariff threats, which actually, maybe they're actually going to be looking more like negotiation tactics. But then we've also had more appointments and announcements for Trump's cabinet. Then we had US data, okay? So we had US data ahead of the Thanksgiving weekend, and broadly speaking, that showed the US economy to be fairly resilient. We had core PCE rise, that's the Fed preferred gauge for inflation. We also saw US Q3 GDP upwardly revised. We saw jobless claims hold strong. So the picture was broadly one of a resilient US economy. So let's just keep that in mind as we head into next week. This is the economic calendar on our page. I'm just going to filter it for high volatility expected. To see what we've got going on this week. So I think there's quite a lot. Don't forget there's data from China out over this weekend. We've also got then, as we kick off on Monday, Caixin manufacturing. We've also got the services PMI. We've also got the official data, as I said, on Saturday. And then obviously the big focus for next week is going to be US non-farm payrolls. So let's not forget, we've got the US Federal Reserve meeting on the 17th and 18th of December. So this is going to be the final payroll data that we get ahead of the interest rate decision. Now, what we've been seeing so far is that, as I said, data from the US is proving to be relatively resilient. You know, jobless claims remain low. We've got the upward revision to GDP. We've seen PMIs are strong. We've seen inflation is proving to be a little bit sticky. But it's close to the Fed's 2% target. As far as non-farm payrolls are expected this week, I mean, if you remember going back to last month's non-farm payrolls, the figure came in significantly weaker than expected at just 12,000. So, you know, it was really, really weaker in October. And that was basically because of the strike action and the hurricane disruption. Now, so I mean, because we knew that there were quite a few sort of mitigating factors or factors as to why that was so weak, the Federal Reserve will have looked through that. But I think overall, it's worth pointing out that the overall trend in hiring is slowing. And so with that in mind, it does mean that the inflation backdrop is less threatening for the Federal Reserve as we are right now. So we're expecting 183,000 again in payrolls in November. Not particularly strong, not particularly weak, but it is weaker than perhaps those 200 figures that we were seeing, you know, just 6 months or so ago. So that will help support the view that the Federal Reserve is expected to cut interest rates by 25 basis points in the December meeting. The thing is that we need to bear in mind here is it's not just all about what the Fed is doing, it's also about what might be expected from Trump. And I think the market is also keeping that in mind. Obviously, we had the Treasury Secretary appointment this week, which was Scott Bessent, who's considered to be he's trusted by Wall Street. He's a Wall Street old hand. So he's or hoped to be sort of like a slightly moderating tone to President Trump. He's more in favor of targeted tariffs rather than blanket trade tariffs. So things like that, which are expected to mean that we'll see potentially less inflationary measures from Trump. Although we are expecting inflationary measures from Trump, they just might be not perhaps as inflationary as was initially feared when he took office. And we've seen that reflected in the US 10-year Treasury yield, which has slipped lower. And we've also seen that then reflected in the US dollar. This is the US dollar, which has also ticked lower. If we get stronger than expected jobs data, then obviously that is going to just remind the market that the US economy is strong and could just see sort of expectations for rate cuts for next year reined in. I mean, at the moment, the market's pricing in around a 68% probability of a rate cut in December. That's up from 55% at the start of the week. So because of that change in rate cut expectations as well, we've seen the US dollar come off. So if we see stronger than expected jobs data, that's going to be bullish for the US dollar. US dollar is actually just testing this level around here at 106. It's the high that we saw back in June. It's still, although we rose to that multi-year high, didn't we, earlier this time last week, that has come off, but we're still above this trend line, which dates back to October last year. So we still remain above that trend line. Key levels to watch out for, 106. So we did have an attempt to break below that, but that long lower wick there suggests that there was a little bit selling pressure at those lower levels. If we do see a close below that 106 level, then look at 105.50. That's going to be the level to be watching out for on the downside after that. and then after that 104.50. It's a level that sort of offered some support along the way here. But interestingly, so we were actually seeing this golden cross forming on the US dollar, which is the 50 SMA, which is crossing above the 200 SMA, and that's usually a bullish signal. So just as far as the upside is concerned, I think on the upside you'd be looking for if that 106 level holds, 107 would be the natural next level before we look to this level here, which was the high that we saw in October 2023, which is the 107.35. Just having a quick look now at the at US stocks and what this means for US stocks. As I said, trading around all-time highs here. We're just seeing the RSI bearish divergence slightly, so we might find that actually this is starting to run out of steam, which would be interesting because obviously we're entering into December. I mean, the Santa rally, but it's something to worth keeping in mind about December. But just remember, Santa rally doesn't happen across the whole of December. It tends to be something that we tend to see focused towards the latter part of December, and obviously just because it's happened previously, it doesn't happen every year, the Santa rally. So that's just something to keep in mind. There is a potential for us to see a little bit of a pullback as momentum sort of runs out of steam from that divergence here, where the RSI is falling and yet we're still sort of moving towards all-time highs. That suggests momentum isn't really on our side anymore. But again, as far as levels to watch, this is the all-time high that we have here of 6,000 at 6,021, I do believe. And above there, I mean, the next natural level to be looking out for would be 61,000 or 60.50 and then 61,000. On the downside, you see it's trading, it looks to be trading within a rising wedge, and a rising wedge typically is a bearish pattern. So, I mean, it doesn't mean to say that it's going to turn bearish just yet, but it, as I said, between that and the fact that we've got this RSI divergence, maybe we could see a little bit of a pullback. 58.80, that's the October high. Just below that, we've got the level here of the 58.30, which was the low that we saw last week. Take out those levels and then we'll be watching out for 5,700. We need a break below that level, which is also the 100 SMA more or less, to create a serious low and low, although there is a near-term breakdown if we have that one. Just having a look here. So again, I mean, talking with regards to the data that we've got going on this week, if we're seeing that we get weaker than expected US jobs data, then that's going to fuel expectations of more aggressive rate cuts, which is beneficial for stocks. So on that note, we might see stocks move higher. This is the NASDAQ we're looking at the moment. It's just testing support around that 20,750, the previous all-time high, the July high. We've seen this grinding higher after it hit the low last week around the 20,300, been grinding higher. But as I said, it's just again struggling around these levels here, around the 20,750. If we do get a fall below that, then that brings 20,300 into focus ahead of the 20,000 psychological level. On the upside, we're close to that all-time high. It is just there at 21,232. So that is the level that the buyers are going to be looking to break above. But again, just have a look here. It's trading within a rising wedge. So that's something just to keep in mind as we look at these trades. So what else have we got going on? We've got Eurozone GDP, Eurozone retail sales. We're going to have a look at the Euro because actually it's really quite interesting what's been happening with the Euro US dollar. It did trade down to that really low level that was on Friday last week, and we had that long lower wick. Okay, now we've seen a recovery, but I think a lot of that recovery is actually owing to US dollar weakness that I've been talking about this year, rather than than anything particularly or any sort of particular fundamental strength story regarding the euro. So, I mean, if we think about the data that we've seen this week, we've seen Eurozone inflation. It has ticked higher. It's up to 2.3%. Sorry, no, that was due to be released today, actually. We've seen German inflation rise to 2.2%. Eurozone inflation was expected to rise to 2.3%, up from 2%. Yeah, at the same time, we've got those concerns over trade tariffs, which could be detrimental to the, or at least hurt the Eurozone economy, make it more fragile. But again, those, you know, we haven't really heard too much from Trump yet until he takes office in January. We're in this sort of sweet spot where, you know, we can only assume, but actually nothing's been said or done. So as far as growth is concerned, we know that the outlook in the Eurozone region is deteriorating. PMI figures were particularly weak, back into contraction. So the ECB is expected to meet in December. They are expected to cut rates. The big question is, will they be cutting rates by 25 basis points or 50 basis points? That's what the market's trying to assess. And, you know, next week's data, GDP figures will help to assess that, because obviously if we've got weaker GDP data, it's just a revision, this one, but if we do see a downward revision, then that could send the euro downwards. I think if we're looking to have any sort of sensible recovery and get the euro back into neutral position, it needs to rise above that 106 level, which is a level that it has struggled to rise against over the past 2 weeks. And then after that would come 107. If we can get above 107, then we really are in neutral territory. Looking up upwards, this is that rising trend line that's been in focus since October 2023. So we are below that now. We've also got that death signal where the 50 SMA is crossing below the 20 SMA and a bearish signal. So I think there is actually potential for more weakness in the euro, but we'll just have to wait and see. It looks like it's struggling to get anywhere near 106 today. But the levels, yeah, on the downside to be watching, obviously you've got round numbers 105, then you've got this 104.50, which was the low for 2023. And then we've got the 2024 low at 103.30. Whilst we're talking about Europe, let's just have a quick look at the DAX. I think it's quite interesting. Sorry, whilst we're talking about the euro as well, just to keep in mind, there is also a lot of political uncertainty in Europe, particularly in France at the moment, where we've got the budget going on, where Michel Barnier is trying to push the budget through, and he's struggling basically because of the coalition government. It's a very weak government, having to really trying to look to get expenses and financial stability in France, which is suffering, and yet at the same time he's might have to make some concessions, or is having to make some concessions. So he's not being able to cut spending to the extent that which he would like to cut spending, because of Marine Le Pen, who has potential to call a vote of no confidence, which would throw the government into complete chaos as well. So they're trying to get this budget through. If they can get the budget through without too many concessions, then maybe that will survive. But there is a potential that the French government won't survive past the end of next week, let alone to Christmas, if Michel Barnier is not willing to make too many concessions. And if he does make those concessions, then that actually puts the outlook for the French economy into question as well. So we've seen, this is the French CAC that we're just having a look at here. It trades down 6% across the year. We've seen this weakness that's coming in over the last couple of weeks, just holding above the trend line from October 2023. But yeah, we're seeing sort of a sell-off in French assets, treasuries, etc. In Europe, which really does differentiate Europe from the US, where we're seeing these all-time highs. Now, this is Germany, this is the DAX. DAX is actually just looking like it's trying to break out, actually. we've got sort of that rise above this level here, which is the 19,500, which is a level which has been capping the DAX actually since the beginning of the month. It's traded in a pretty much a consolidating pattern. We've capped on the upside by 19,500, on the bottom side by 19,000. So we're just taking out that 19,500, which if we do, then opens the door to the upside, which is the all-time high of 19,680. And that is the all-time high. But as I said, the fundamental picture is a little bit weaker in the sense that we do have political uncertainty in Germany as well. Obviously, if Trump does bring in trade tariffs, then that could hurt the automobile industry in Germany. But anyway, we're still managing to find some upside on optimism that the ECB will be cutting rates, making life easier for businesses in Germany. So let's have a look what else. As I said, we've got quite a lot of stuff going on from China. So let's just take a quick look at what that means for Chinese stocks. Chinese stocks have been suffering actually. They haven't, you know, we're talking about sort of differentials. We're talking about how we've got the, you know, the US S&P at all-time highs. We're seeing a little bit of consolidation in Europe, but actually we're seeing China is struggling after we saw that sort of that peak and the measurement, the stimulus announcement. We've actually given up half of those gains and we're just really consolidating. But I mean, if we're looking at where we are since the beginning of November, which is when Trump came into power, then we are trading lower. Levels to be watching out here for is that 13,000 on the downside. I mean, if we get a break sort of below that 13,000 level, then that's going to expose the 200 SMA. As far as China's data is concerned, as I said, it's the services and the manufacturing PMIs, which are expected to be, well, they have been lackluster in recent months. We're expecting, well, the services was just over 52. It was just 52 actually in November, so just into expansionary territory, whilst the manufacturing barely in expansionary territory. So the market's going to be watching close to see whether we're starting to see any of those stimulus measures sort of feed through into the market. As a result, that could then impact the Chinese stock market. As levels on the upside to be watching there is going to be 13,500 more or less. That's also the 50 SMA. Let's just have a look at what's going on in the Hang Seng. I would say it looks a little bit weaker than the Chinese 50. We've seen that break below from the level up here that we were looking at back at the time of the election of 21,400. We've seen the price come lower. It's come below the 50 SMA. It's taken out this level here, which was the high we saw back in May. Are finding some support on the 100 SMA. So, you know, we're just finding that it's levels to be watching on the upside, 19,800, and on the downside I'd be watching out for the 100 SMA there at 1890. If we get a break below there, then watch out for 1850 on the downside. And then let's just also talk about oil. So when we talk about China, I think it's also useful to be talking about oil. So the oil price has been quite interesting this week. Obviously, we've had some news out as far as a ceasefire between Hezbollah in Lebanon and Israel, which is good news as far as the markets are concerned, but the oil market as well has seen the geopolitical risk premium come off. And that's why we saw a sharp sell-off at the start of the week on the news of that ceasefire. So the OPEC Plus meeting was supposed to be this weekend. It has actually been delayed to postponed for a week until next weekend. But the OPEC Plus are not expected to be unwinding the output production cuts that they had been planning on. So that is offering at least some support to the oil price. But again, as far as the chart is concerned, we're very much in this holding pattern. So just as far as we're concerned, if we get strong data from China, then that's obviously going to be encouraging for the oil demand outlook. Any news that the economy is holding up can help the oil demand outlook. As far as, but if we get weaker data, then that could be depressing for the oil demand outlook. So levels to be watching on the downside, we've been watching it for quite some time now. It's just this level here, which is the 67.50, 67.25, sorry. If we do get a break below that, then watch out for the 65.25 level down here. On the upside, buyers need to break out of that 71.50, 72.50 range in order to bring 75 and create a higher high. Obviously, if we get sort of a break below this 67.50, 66.50 sort of zone, then that's going to create a lower low. But as I said, you know, we've been caught in this holding pattern for quite some time. Watch out for those breakouts should they happen. And just finally, I think the other thing to be keeping in mind is we've been talking about sort of oil is also geopolitical risk. Premiums, obviously we've had the ceasefire agreement deal between Israel and Hezbollah of Lebanon, but we do have still concerns, geopolitical risk in Russia and Ukraine. I think there are concerns of that ramping up as Putin threatens more into ballistic missile tests over there. So, I mean, there's signs that that's ramping up, and that's just helping the gold price, which is also finding support from the weaker US dollar this week. So we had this big sell-off on Monday, but actually we've seen the prices been grinding higher. Now, I think a lot depends on what happens around this 2,668, 50 SMA, and also the level here, which is the 2685. That was the high that we saw back in September. So we've got a zone that's going to need to break above in order to get above the 2720, which was the high from last week, and towards the 2750 level. Failure to get above that, I think, does mean that we could be sort of remain in this bearish near-term trend, which does bring the 2600 level into focus on the downside. And then below that, the 2550. But we are just, interestingly, I just think it's worth keeping an eye on this. Let's just change to a weekly chart. On the 100 SMA, we recovered off that 100 SMA there, which is, you know, we've been trading above the 100 SMA now for really quite some time. So it is just, yeah, that seems to be a pretty solid support level, and that's at 2575. So they are the levels to be keeping a track of. Excellent. So I think, I mean, we always rush through, don't we? There's so much to talk about, but we got through China, we got through US non-farm payrolls, we got through Eurozone GDP, we've also got the retail sales. We looked at the yen, we've looked at gold, and we've looked at oil. So I hope you've enjoyed the session, and I look forward to seeing you next week.